We are jumping straight into the deep end today.
We really are.
Because what is happening in the global markets right now? I mean, specifically this week, January 2026, is something we're going to be reading about in textbooks for years.
Oh, absolutely.
This isn't just a price spike. We're looking at a mechanical breakdown in the world's most important industrial metal market.
It's a classic squeeze, but the scale is what makes it unprecedented.
Right.
Usually when we talk about commodities, it's all about supply and demand over months, maybe years. What we're seeing this week in copper is a crisis measured in hours.
In hours, exactly. And for anyone who thinks copper is just, boring plumbing and wiring, you need to look at the London Metal Exchange right now. We saw prices hit a record high on January 14th, $13,407 per ton. That's the big headline number.
That's the number everyone sees.
But if you dig into the actual trade data, which is what we're doing today, the spot price is actually the least interesting part of this whole story.
I completely agree. The price is just the symptom. The disease, or maybe the drama, I should say, is happening in the spread structure.
An invisible war.
It's an invisible war happening in the contract expiry dates.
Okay, so that's our mission today. We're going to map out this war. We have three massive, mysterious entities. Let's just call them the whales for now.
Whales, I like it.
Who have effectively cornered the market. We have a panic in something called the Tomnex spread that rivals the chaos of 1998.
It really does.
And we have physical metal starting to move in ways that just defy standard logistics.
It's a perfect storm. It's financial positioning crashing right into physical reality.
So let's start there. Let's start with the mechanic that triggered the alarm bells on Tuesday, the Tomnex spread.
Right.
Now, for the uninitiated, this isn't a rom-com title. It stands for tomorrow next day.
Exactly.
In a normal functioning market, this spread is basically the cost of carry. Right?
Yeah.
Just the cost of financing copper for 24 hours.
Precisely. Under normal conditions, the Tomnex spread is, it's boring. It reflects interest rates, a tiny bit of storage insurance.
Pennies.
You're talking pennies, maybe $1 or $2. It's the lubrication that keeps the futures market rolling forward smoothly.
But on Tuesday, that lubrication it dried up. The spread didn't just rise, it exploded.
It really did.
We saw it spike to $100 per ton.
$100.
And just to clarify for everyone, that is $100 just to roll a position for one single day.
It's an annualized rate that would make a loan shark blush. And to put that $100 in context, just 24 hours before, the market was in contango.
Meaning it was at a discount?
It was at a discount, yeah. So we went from a relaxed market, plenty of immediate supply, to a situation where traders were paying a historic premium just to get metal immediately or to avoid delivering it.
And you have to go back a long, long way to find a comparison for this. I was looking at the charts, and this level of volatility really only has one true peer, 1998.
The Sumitomo crisis.
Right. The Sumitomo copper affair. That was Yasuo Hamanaka, Mr. 5%, who tried to corner the entire global copper market.
And it ended in a massive scandal. Billions in losses.
So when we see the Tomnex spread hitting these levels again in 2026, it suggests we're dealing with forces of that same magnitude.
It does. And it's similar to the 2021 squeeze as well, but the mechanics here, they feel more acute.
Why is that?
Because of the inventory levels. That $100 spread is the market screaming, we are out of time. It forces every single participant to show their hand.
Okay, so let's look at the hands on the table. Who is on the other side of this? The data from the LME is pointing to a massive concentration of positions. We have three entities, and of course, the LME doesn't name names, so it could be a trading house, a hedge fund.
Or a state-backed actor.
Holding over 30% of the long positions for January.
And that 30% is the magic number. In a vacuum, holding 30% of a contract month isn't illegal. When you compare that 30% to the amount of copper actually sitting in the warehouses, the math just breaks.
Let's run those numbers. 30% of the open interest for this contract. That translates to roughly 130,000 tons of copper.
Which is a lot of metal.
It's an enormous amount of metal to demand all at once.
It is.
To visualize that for a second, a standard shipping container holds what? Maybe 20, 25 tons of copper.
Around there, yeah.
So we were talking about 5,000 or 6,000 shipping containers worth of metal that these three entities are technically asking to be delivered.
And there's the problem.
The problem, as I understand it, is that the LME warehouses simply do not have 130,000 tons of accessible copper ready to hand over.
That is exactly the choke point. We have low inventory levels globally, but the on-warrant stocks, that's the metal that is tagged and ready for delivery.
The stuff ready to go out the door.
Right. It's just insufficient to cover that 130,000-ton claim. Yeah. So the whales have effectively bought more tickets than there are seats on the plane.
Which brings us to the shorts.
The shorts.
These are the folks on the other side. Maybe they're miners hedging their production or speculators betting the price would drop. But whoever they are now trapped.
Completely trapped.
They are contractually obligated to deliver copper they don't have to people who definitely want it.
And this is where the squeeze becomes so painful. If you're short, you have two options. Option A, you deliver the physical metal.
Right. Find it, truck it, ship it.
Get it to an LME registered warehouse, which is a logistical nightmare if you need to do it in 24 hours.
Impossible, really. You can't just teleport copper.
You can't. So you're forced into option B. You roll over the position, you buy back your expiring contract for today, and you sell a new one for next month.
You kick the can down the road.
You kick the can down the road.
But because of that $100 Tomnex spread we talked about, buying back your contract today it's excruciatingly expensive.
Exactly. You are walking directly into the fire. You have to pay that massive premium to close your position. And this is how a squeeze works. It bleeds the capital out of the short sellers until they capitulate.
It becomes punitively expensive to stay in the game.
Precisely.
Now, the LME isn't the Wild West. They do have rules to prevent exactly this kind of scenario, right? These lending rules.
They do. They're supposed to be a safety valve.
So if you hold a dominant position, you're obligated to lend that metal back to the market at a capped rate to stop you from holding the market hostage.
That's right. It's designed to keep the market liquid. And usually that cap is around $65 or so, depending on the calculation.
Okay, but we saw the spread hit 100.
And that's the fascinating part. On Tuesday, the spread briefly blew right through that buffer.
So the pressure was so high that even the safety valves failed.
It implies that the mechanism was just overwhelmed, or that the panic buying was happening outside the standard lending logic, even for a brief window.
Wow.
When you see the spread hit 100, when the limit's supposed to be lower, it tells you people were just bypassing rationality. They needed out at any price.
A total dislocation. And this brings up a concept we really need to unpack because it's defining the entire market right now. Backwardation.
The word everyone in commodities fears.
Right. Normal markets are in contango. Prices are higher in the future because you have to pay for storage and insurance and all that.
Sure.
But right now, the LME curve is inverted. The cash price is higher than the 3-month price. The market is saying, I don't care about next year, I need copper today.
And not just for the immediate month. This backwardation is stretching across multiple distant months. That's the market telling us this isn't a temporary glitch.
Not just one trader hitting the wrong button.
Exactly. The market believes that this tightness, this scarcity of copper, is going to persist for a long, long time.
But here's where it gets really strange, and I want to get your take on this. We're seeing this massive squeeze in premium in London on the LME. But if we look across the ocean to New York, to the COMEX, the picture is totally different.
It's baffling at first glance, isn't it? You have COMEX copper trading at a discount, or at least a much smaller premium, while London is just melting up.
So normally, arbitrage would fix this instantly. Traders would see cheap copper in New York, expensive copper in London, buy one, sell the other.
And pocket the difference.
Until the prices align. So why isn't that happening?
Well, it is happening, but physical arbitrage has friction. It takes time. You can click a mouse and buy a futures contract in milliseconds.
But you can't move a cathode of copper from a warehouse in Tucson to Rotterdam in milliseconds?
Exactly. This is the paper versus physical lag. The spread between New York and London has blown out so wide that it is now incredibly profitable to ship metal.
So traders are scrambling to book freight.
They are.
And we actually have hard evidence of this happening on the ground. I was reading the warehouse inventory reports, and there was a specific note about New Orleans.
Yes, the New Orleans LME warehouse.
Which has been a ghost town for copper recently. I mean, effectively empty.
Right.
But suddenly, this week, we're seeing these small inflows of metal arriving there.
That is the arbitrage mechanism waking up. That metal is likely coming from the COMEX system, or domestic U.S. stockpiles, getting trucked or railed into New Orleans to be registered on the LME.
So it can be delivered against these crazy high prices.
That's it. The high prices in London are acting like a giant vacuum cleaner, physically sucking metal out of other regions.
That's the function of a price spike, I guess.
It's the market's way of screaming, send metal here. But until those ships arrive, and that takes weeks, the London market stays starved. The financial reality is just moving faster than the maritime reality.
And it's not just copper. It feels like we are seeing a broader flight to hard assets across the board. I mean, spot silver hit $92 recently.
There is definitely a metal mania psychology taking hold. But the copper situation is unique because of its role in the global economy.
How so?
Silver is largely investment, jewelry. Copper is the backbone of everything.
Which leads us to the bigger question, why now? Is this just three greedy whales trying to make a buck, or is there a fundamental shortage underneath this whole financial game?
It's likely a combination. You can't engineer a squeeze of this magnitude if the market is awash in supply.
So the conditions were right.
The whales saw vulnerability. They saw the stocks were low, they saw production from South America has been spotty, and they saw that demand, despite all the economic headwinds, is surprisingly resilient.
Let's talk about that demand. We touch on the green transition all the time on this show, but this week makes it feel very tangible.
It's real now.
You have millions of EVs, massive wind farms, grid upgrades. All of that is just copper, copper, copper.
It is. And for years, analysts, including myself, I'll admit, have been warning that the supply side isn't ready. We haven't opened enough new mines. The grades of ore are declining.
So when we see three entities hold 30% of the contracts and utter panic ensues, is this a preview of the next decade?
I think it is. Think about it. If you're a massive battery manufacturer or a nation state planning to electrify your entire grid, you cannot afford not to have copper.
You become price inelastic.
Exactly. If the price goes to $15,000, you pay it. If the backwardation is steep, you pay it, because the alternative is shutting down your factories.
That turns copper from a cyclical commodity into a strategic asset. It's almost national security at that point.
Absolutely.
Yeah.
And what we're seeing with these whales might not just be speculation. It could be strategic accumulation.
Meaning?
If you believe there's a structural deficit coming in 2027 or 2028, then grabbing 130,000 tons now, even at record prices, might actually look like a bargain in hindsight.
That is a terrifying thought for anyone trying to manage a construction budget.
Yeah.
But it does align with the data. The LME curves suggest tightness for months to come.
And you have to remember, the liquidity in the LME has been a bit fragile ever since the nickel crisis a few years back. Yeah. So you have a market that's already a bit nervous. You introduce a massive positional move like this, and the volatility just gets amplified.
It's a feedback loop. The volatility scares away the smaller players,
leaving only the hardcore players, which makes the volatility even worse. And that makes the cost of roll, the Tomnex spread, even more erratic.
So let's bring this back to the so what for our listener. Why does a $100 spread on the London Metal Exchange matter to someone who isn't a commodities trader?
It matters because this volatility inevitably trickles down. This isn't just some casino game for bankers.
Okay.
When the cost of hedging copper explodes, or when the physical metal gets locked up in these financial games, the real-world cost of manufacturing goes up.
Right. If you're a wire manufacturer and you can't hedge your price risk because the market is in backwardation and the spreads are blowing out,
you have to raise your prices to protect yourself.
So it feeds inflation.
It feeds inflation. It delays projects, and it highlights the fragility of the whole just-in-time supply chain model we built.
We built a global economy on the assumption that we could always get what we needed when we needed it for a standard price.
And this week proves that assumption is dangerous.
It's a wake-up call that paper contracts are not the same as physical possession.
Not at all.
You can hold a contract that says you own copper, but if the market is squeezed, good luck getting it to your factory door.
That is the ultimate lesson here. In a crisis, possession is 10/10 of the law. The divergence between the COMEX and the LME proves that location matters and physical inventory matters.
I want to leave everyone with one final thought to mull over. We spent a lot of time talking about the whales today. Three entities holding 30% of the market. If three entities can bring the world's premier metal exchange to its knees and trigger a 1998 level crisis, what does that say about the security of the entire green energy transition?
It says the transition is built on a very, very shaky foundation.
If we're moving toward a world where copper is the new oil, then the LME is the new Strait of Hormuz. And right now, that strait is looking very, very clogged.
That's a very apt analogy. And as we watch those ships slowly moving from New Orleans to London, we're watching the market try to heal itself. but it's going to be a bumpy ride.
We will certainly be keeping an eye on the Tom Next spread, so you don't have to. Thanks for helping us break down this financial thriller.
Anytime. It's never a dull moment in the metal markets.
Thanks for listening to The Deep Dive. Stay curious, and we'll catch you in the next one.